Okie dokie. Okie dokie, everyone. Can I start off by saying either a good morning or good afternoon or even a good evening, depending on where you are around the world. And thank you for joining me on tonight's latest episode of How I, series for Stratton Markets. Tonight's episode is called How I Took My First Steps into the World of Trading. Written by myself, which is James Trescothick, who is the Chief Trading Educator here at Stratton Markets. Now, of course, I'm talking about online trading or trading in general. And like with every type of investment, it does indeed carry a great deal of risk. So I do suggest you do your own research and your own due diligence and know of the risks at hand before entering any trade. Now, with that out of the way, because like I say, it's a bit of a personal journey tonight, and this is tonight's agenda. Starting off with, not the question and answer, of course, that's probably animation. Starting off with my personal journey, how I got involved in this market. Then it's about the beginning of how I started to learn about the different markets. Then it was about me discovering who I was and learning a different trading style. Then it was about me understanding what fundamentals are, because I started many years back, as you will find out, before technicals, so fundamentals were more of a key part when it came to trading. And then it will becoming the most important factor, how I actually overcome my fear and how I was, I'm overcoming my fear about stepping into the market. Because when you're starting off, it's all about overcoming that fear of doing that first trade or second trade or third trade, etc. Then, of course, it's all about finding my plan. Now, here's the thing about me. Those who know me know I am very passionate and very animated. And not being funny, I had two directions with my life, or what I wanted to be. One was a filmmaker. I love movies. I love films. So one was being a filmmaker. The other was actually being a broker. And that goes down to the fact that because of my love of movies, I was probably about maybe, think about it, maybe 11, 12. No, younger than that. Maybe around about 10, 11. And I watched a movie called Wall Street. And that got me interested in stockbroking and the financial markets. So really, I was at a point of my life where, well, a point of time, not when I was obviously 11, 12, but I had two choices, two things I wanted to do, either a filmmaker or a broker. And luckily, by chance, I got the best of both worlds. I actually end up being able to discuss the markets, get involved in the markets, love the markets, and at the same time, make educational videos. So I did sort of got the best of both worlds of what I wanted to be. Now, it's a little bit more of an introduction on me or who I am. Now, I've been, obviously my role is the Chief Trading Educator at Stratton Markets, but I've been actually in the financial services industry since, for over 20 years, since the age of 18. I'm now 40, believe it or not. And I started off actually in the financial markets as a mortgage broker, completely separate from what I'm doing now and what I wanted to be. And I did no videos or anything like that to what I wanted. But I started off as a mortgage broker, moving the pensions and alternative investments. Then by chance, I got into portfolio management. These were more long-term investments, but more the sort of thing I wanted to do. And after that, I then got involved in actually trading itself. Now, since then, since this amount of time I've been in the industry, I've been in the trading industry for nearly 14 years. I've indeed been a published writer, and I've been published in several leading industry publications. And as you can tell, and as I've already mentioned, I'm a very avid market commentator. I'm very passionate about this marketplace, and I talk a lot about it. And because of, again, filmmaker, actor type thing in my DNA, so to speak, I'm also a well-known public speaker, and I've spoken at several events around the world. So all that formed into the person who I am and what I do and how I took, and how I got involved. And this is all about how I got involved in the industry to begin with. Now, one of the first things I did was, first of all, which is not in part of this presentation, I learned a bit about the mechanics of the industry, what a pip is, what leverage is, and that's for another presentation. I've done that quite a few times. But I started learning that with trading, it's like a 24-hour market, especially when it comes to currencies. So then it's all about really learning about the different trading sessions. Because like I say, the forex market opens, depending on winter or summertime, really on a Monday morning at either 6 a.m. or 7 a.m., depending on winter or summer, and closes at 5 p.m. New York time on a Friday. So it's like from Monday to Friday. Okay, it opens with Australia on a Monday and then stays open and closes New York time on a Friday, 5 p.m. New York time on a Friday. So it's a 24-hour market. So then I started to learn about these sessions, understanding that it's constantly moving. And this is really probably why a lot of the excitement comes from this market, because it's a constant market. Now, because it's 24 hours, obviously it opens in different, 3 different sessions, because the world doesn't stay awake all the time. So I took the time out to start to learn about the different trading sessions. Now, the first session, of course, which starts the market, is the Asian session, which is Sydney, Tokyo. And this starts off around about, like I say, 7 a.m. or 6 a.m. winter summertime, and closes around 5 p.m. Sydney time, or 11 p.m. and 8 a.m. GMT summertime. Now, this is the smallest session, okay, in terms of trading volumes, because they don't have an awful lot of weight. They're not major exchanges, etc. And the main countries involved really during this period of time is really Sydney, Tokyo, and Singapore, which means that the currencies which are most liquid or most at focus is obviously the Aussie dollar, the New Zealand dollar, and the Japanese yen, which makes sense because both Australia, New Zealand, and Japan are wide awake during these periods of time. The next session I learned about, which is the session I tend to operate in because, as you can tell, I'm a Brit, so I'm awake during European hours, is a European session, or really London. Now, London opens at 8 a.m. GMT and closes at 4 p.m. GMT. It's the biggest trading session and makes up nearly 50% of the total trading volumes, and it's extremely, extremely liquid. Now, the countries involved around this time, or the cities, should I say, the capitals involved at this time, includes the likes of London, Paris, Frankfurt, easy for me to say, and Zurich. Clearly, as these cities are in operational, the currencies to watch include the likes of the euro, British pound, and the Swiss franc. The next session I learnt about, understood about, and got to understand was the North American session, otherwise known as New York. Now, this opens around about 8 a.m. and closes at 5 p.m. This is New York time, okay, which is 1 p.m. to 10 p.m. GMT. It's the second biggest trading session in volume, so it's highly liquid. These sessions, or during this session, it consists of cities like New York, Chicago, and Toronto. Currencies to watch during this time, which are the most liquid, includes the like of the US dollar and the Canadian dollar, which of course makes sense because American is wide awake and Canada is wide awake as well. But here's the thing about this session, and this is something which I took the time out to learn a lot, especially as I started off as a gold trader, is that it actually crosses over with the European session, which means it has huge potential to be extremely, extremely volatile, because it makes sense. You have the two sessions trading at the same time. And the reason why I paid attention to this is because I was a gold trader. So gold obviously is really influenced really a lot by dollar strength. So really, this was the crossover period. It was the time I used to pay a lot of attention to gold prices. However, when Europe closes, and in the last couple of hours, liquidity slows down. So when you got the closing hours in New York, then you see liquidity dries up and the volatility dries up, which then pays sort of attention to the Asian session. Because the Asian session is the smallest, very little chance of them having the weight to change direction. So sometimes or not always, of course, because certain things can happen. Whatever direction something is actually moving in at the end of the US session can potentially, not always, potentially carry on its movement or the same direction as the Asian session, because the Asian session doesn't carry that much weight. And this is again something I paid attention when I started out. At the same time, I started to learn a little bit about the average pip movement between the trading sessions to find out if I was more of a high volatile type of trader or a less volatile type of trader. Now, here's the thing. This is something interesting. And looking, here's the majors. Obviously, we've got the euro dollar, the cable, which is the British pound, US dollar, the dollar, Japanese yen, the Aussie, which is the Aussie dollar, US dollar, the Kiwi, which is New Zealand dollar, US dollar, the loonie, which is the dollar CAD, and a dollar Swiss franc, which is simply known as obviously the Swiss franc. Now, as you can see, depending on the sessions, the volatility changes. New York, for the euro dollar, just taking that example, the average pip movement is around about 92 pips, Tokyo 76, but London, you can see, is a lot busier, 114. British pound, the same, 99 during New York, 92 during Tokyo, but 127 during London. The yen, 59 during New York, 51 Tokyo. Again, it's a dollar is the major currency. So again, it's what the movement is. And London is 66. So the reason why I started paying attention to the pip movements is because depending on who I was or how I traded, if I was not so, if I was more risk adverse, I would trade possibly during the quieter hours, like the Asian session. If I was into more high risk, high movement, then I would look at London and the New York session. And that's when I would look at trading during those times. Then, after knowing this, after knowing the sessions, after knowing the mechanics of the instruments, I decided to take the time out to understand a little bit about the different trading styles, because there's lots of different trading styles out there. And the reason why I took the time out to learn this is because I wanted to decide or discover, shall I say, what type of trader I was. Now, there's several major different trading styles. First of all, there's a position trader. These type of traders are long-term. They have a long-term view, and they will hold their positions open for maybe months or even years. Then there's a swing trader. These type of people or these type of traders, they're more short-term, and they hold their trades open from days to weeks. They're looking between the highs and lows and going and selling from the high, closing at the low, and then buying at the low, and then selling and then closing at the high. So days to weeks. Then there's day traders who are short-term again. Again, they only do over, day-only positions. They close it overnight. They don't hold it open. So they're very quick in and out. But even quicker than that are scalp traders, who do very short-term positions, and they only open their positions between seconds to minutes with no overnight positions whatsoever. So I took the time out to try and understand the different trading styles, to try and fit around my need, around my sort of day-to-day schedule and the type of person I was. Now, obviously, I was working for a prop company, so I could hedge and I could basically build my portfolio between the number of position, swing, day, and scalp. I worked out that scalp trading sometimes I was good at during high volatile events like news announcements, but realistically, I was more of a swing trader, which I went into the market at a calmer time, and I was a combination of a position trader because it fitted my type of personality where I saw maybe a overall view of where something may go. So I would hold on to my positions a little bit longer. So I realized after taking the time out, what fitted my day-to-day schedule, I was more of a day swing position and occasionally going into scalping on high market events. But again, trading was my full-time job. If it's not your full-time job, then you need to have a look at this and work out where this fits in to A, your day-to-day schedule, B, the type of person you are, and really your attitude to risk and how you see yourself. So again, this was the next thing I discovered and looked into to try and work out, who I was and how I could take my first steps into trading. And of course, this is how I would prepare my trading day. I learned to get into a routine, because being prepared, prevents you from any possible surprises. The outlook, in my personal opinion, you should take is always preparing your trading week and even month. Again, like I say, it depends on your trading style you discover, fits your needs, etc. So I looked at this. Now, I started off more fundamental driven. So, because I traded gold back when I started, which was 14 years ago, technical analysis was a minor thing. Well, certainly when it came to gold, we really looked at the fundamental supply and demand needs. So I got to understand the fundamental analysis behind assets and certain assets I was trading. Now, fundamental analysis is the study of microeconomic effects that can affect economies, stocks, forex, commodities, and companies. Fundamental analysis can also include global events, politics, and conflict. Now, traders tend to use fundamental analysis to try and forecast future price movements. Basically, in a nutshell, traders use fundamental analysis to look for the actual intrinsic value of an asset, how much that asset is actually worth. Now, by studying economic conditions, industry conditions, supply and demand factors, following economic indicators, an investor can look at an asset or an asset's current price and establish if it's indeed undervalued or overvalued. Now, certainly in the forex market, and in some ways, some commodities like oil or energies, even soft commodities like sugar, cocoa, and coffee, people look at economic indicators. And economic indicators in particular really can affect currencies a lot. And economic indicators, I took the time out to learn this. Economic indicators are statistics that can point to where an economy is heading. And there are three types of indicators: leading, coincident, and lagging indicators. Now, examples of some of these economic indicators include the likes of this: the consumer price index, employment figures like the non-farm payroll, which is US data, retail sales, industrial production, producer price index, gross domestic product, and interest rate decisions. All these can play a part in the movement of currencies or indeed commodities. So again, how I started off, I started to learn how these indicators can indeed affect the market and what they're about, what information they're giving us. For example, consumer price index, inflation, the rise in price of goods. How will a central bank react if inflation is rising? Let's get my little pen, actually, make it flashy. Here we go. Employment figures. Makes sense. Employment's going up, economy is strong, good for a currency. Retail sales. Why is that important? Well, modern day economies are based upon us buying and selling goods. So the more we buy, the more we're spending money, the more the money's in the system. So that is good. Industrial production, more stuff we're making, also very good. producer price index, the more things are going up in price for producers to buy, how will the central bank actually react? Gross domestic product, how healthy is an economy? If the economy is growing, clearly that will make the currency stronger. And interest rate decisions, if they raise or lower interest rates, how will that affect the currency value? Higher interest rates, more valuable the currency. Lower interest rates potentially can weaken that currency. So like I say, I took the time out to learn what these things meant and how they could possibly affect the market. So how do I prepare for my day? Well, first of all, I learned to read the financial calendar. What events is due that day, that week, that month, what the expectation is, and what the actual previous number was, and how important the event was. Like, for example, ECB deposit rate, obviously very important to the likes of, say, the euro. So I learned what these events were. I started getting into the mindset to check this every day and know a week ahead what is coming up. I also read up on business news. That's the first thing I would do every day. Read Bloomberg, read, Market Watch, Financial Times, BBC Business News. Find out what the story is, what the market was talking about, so I understood what was going on. I got myself into the habit of doing this at the same time. But that was not all. Because then, at the same time, I realized, bear in mind, I was a prop trader. I was trading for a company. When you're trading with someone's money, it's just as scary as you're trading with someone with your own, or even scarier when you're trading with your own. Is overcoming that fear of placing that first trade or placing trades. Now, the biggest fears of trading includes the likes of the following. Fear, obviously, of losing. Duh, of course it is. Fear of missing out. Fear of not being right. We're human, and let's face it, we all like being right. We don't like to be proved wrong because we all have egos. The fear of not being right. The fear of letting a profit turn into a loss. So these are the biggest fears when it comes to trading. So I had to write down my fears and understand them and then find a solution how to overcome them. How I overcame the fear of trading. Fear of losing. The solution I came to is really simple. Guess what, everyone? Losing is a part of trading. So never trade. So not all trades will you will always lose at some point. So never trade with more than you can afford to lose and implement risk management. So I got the grips with, okay, I'm going to lose at some point, or some trades are going to be lost. Then I got to overcome my fear of losing because it's part of the game. Fear of missing out. I took out greed. And I took out passion from my decision making. Instead, I used patience and I researched my ideas. I also, again, implemented risk management, such as limit orders and stop losses. And I understood that even if I was missing out on an opportunity, it didn't matter. The market is not going anywhere. So if I miss out today, tomorrow, I can go into the market with maybe a clearer head and a better overall plan and strategy. Fear of not being right. Solution? I understood that I'm just James. I'm this tiny 5'5", hairy, wrinkly individual. Occasionally likes the sound of his own voice. And though I have my ideas, my opinions, I am not bigger than the market. The market is far, far bigger than me. And I will not be right all the time. I came to terms with that I was not going to be right all the time. And I understood that being right does not mean, even if I am right, does not mean I will always be in profit. And I again understood the importance of implementing risk management. Fear of letting a profit turn into a loss. Oh man, the battle of hope and fear, which I've done on so many different episodes. But this is one of the biggest battles. And I learned it the hard way. Okay. You know, I understood that sometimes the emotions you go through, I got to understand myself. I got to understand the emotions, the hope that when I'm in a loss, it will turn around, the fear that when I was in a profit, it will go against me. I got to understand this. Understand why it happens, why I went through this. I call me a geek, but I read up about the part of your brain, the limbic system, which controls both your fear and your memory. So I understood why these things were happening or why I would go through these emotions. And I started to get around it, keep a trader's diary. And I started developing a trading plan. And I learned that I had to keep to it no matter what. So I went back to basics. And this is the thing. This is an idea of a trader's plan. They're all made up numbers. But basically, I wrote an Excel sheet where the date, instrument I was trading, the direction I went, entry level, stop loss, take profit, reasons, and obviously I wrote down the income, the outcome. But the thing is, this is what I started learning to do. I took a lot of time and patience to do it. I write down, obviously, the date first, the instrument first, the direction, the entry level, the stop loss I was going to put in, and the take profit, and the reasons or why I was doing that trade. I would fill in all these boxes first before clicking trade now. And once I filled in these boxes, I would click trade. Now, for one, this is a good way of controlling your emotions. It's a good way of going into the market with a plan. But at the same time, you can then look back on this and work out what type of strategy works for you. Are you more like, going on the fundamentals? Does the RSI work for you? Are you, again, more into Bollinger Bands? Whatever. But basically, by doing it this way, you're taking the emotions out and you're thinking it at a more focused point and opinion, and that's how you learn it. And that's how I did it. This is how I started to learn my strategy and my technique. Now, up and coming educational events includes on the 15th of January is how I learned to trade breakouts and fake outs. I'm going back to technicals on that. 22nd of January is how I learned about the different time frames. 29th of January is how I got to understand trading stocks, CFDs. Again, I always believe in diversifying your portfolio. So I'll be doing one on the 29th as well about stocks. If you wish to speak to me, by all means, you can email me at james@strattonmarkets.com or indeed follow me on my Twitter account, which is at J Trescothick. You can direct message me, follow me, whatever. Or just, reach out to me because I get lonely. Now, don't forget, we've been talking about trading and CFD trading, and like all types of investments, it does indeed carry a great deal of risk. So I do suggest you do your own due diligence and your own research and know the risks involved before entering any trade. With that out of the way, I can see there's no questions, so I would suggest you email me or contact me on my Twitter. If you have any questions, please feel free to let me know. Anyway, till next time, can I wish every single one of you, depending on where you are around the world, either a good morning, good afternoon, or even a good evening, like I said, depending on where you are around the world. Till next time, major thank you for attending tonight and keeping me company. Till then, every single one of you, trade safe.